Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Before I introduce you to today's Maverick, I want to make a request that if you like what you hear during today's episode, well, give us a thumbs up and subscribe to the show to never miss an episode. And if you love what you hear, give us a written review. Plus, be sure to take a look at the description in the episode as we packed it with thousands of dollars in free resources. Now, today, we've got the privilege to learn from a person with decades experience in real estate investing and syndication. Now, prior to being a syndicator, he was a builder focused on construction. It all changed when he figured out how to maximize his time, his dollars, and his cents for himself and his investors. I would describe today's Maverick as someone who's absolutely passionate about identifying value when it comes to finding deals. I've got Shannon Robnett here with me. I'm excited to talk to him. Shannon, how are you?
Good, Neil. How are you?
I'm doing great, man. It's good to see you. So maybe give us a 30,000 foot level. Who are you? Where are you from? And what do you do?
So my name is Shannon Robnett. I am a second generation builder developer, fourth generation realtor. I've been doing real estate construction development for about 29 years. So I'm just starting to get the hang of it. And I've been doing that primarily in the Boise, Idaho market, but we're also in Washington, Florida, Texas, and any other market that seems to make sense.
Yeah. Tell me about the very first commercial deal you ever did, whether you built it or you bought it, whatever it happens to be.
The very first commercial deal I ever did, and this is really where I got my start in development. I was working for my father, building a warehouse, and I got to know the neighbor lady next door who was elderly. She had a mentally handicapped son, and she lived in a house in an industrial area, and she didn't know what to do. The house was old and drafty. She felt like she needed to make a move and do something before she died, and her son was left to try and figure this out. They were going to move into a nursing home together. And I was also talking with my crane operator who needed 5 acres to park his equipment on in an old house for an office. And so, Neil, I was 21 years old. I was broke. I just gotten married, and I didn't take my last $500. I took my only $500 over there, and I got that piece under contract. I went to the city. I got it zoned correctly. I went and talked to my crane operator, and I sold that deal to him, and he's still there to this day. But that was really where I understood that it was not about me building a building, because I was building a building right next door, and I was making some money, but I made a lot more money by understanding the problem of two people, which is really all development is. It's understanding the problem and solving that problem. And when I was able to do that, I really began my career. So then fast forward 10 years, I was still building for other people, but I also understood that I could build this and own this for myself. So in 2001, I built my first industrial building for myself. I still have 2 of the original tenants in there, even though one of the businesses has sold 3 times.
Wow.
It's a gelato ice cream place. Where are you going to make 1,800 square foot of commercial kitchen and I think he's got a 600 square foot walk-in cooler, right? He's not going to move anywhere, but the business is still viable. And so when I saw that and I really got a hold of that, then I really kind of got my company to the place where we don't work for anybody else anymore. We build and develop our own stuff. We buy value add. We do office renovations. We do all that. But it really became me seeing that I was going to be my best customer rather than just being a for-hire contractor that did it and then gave that profitability and that upside of the rental that we, was going to happen inside the building we just created. So that was really kind of my source of inspiration to get where I'm at.
That's where it started. Tell me about your most recent deal.
The most recent deal that we closed, I bought a existing warehouse. It's in an opportunity zone. It's one block from a mall. It's on the major route, major intersection. I think there's 53,000 cars a day out front. It's a warehouse strip center, but it's in a rezone opportunity where we'll we're in front of the city right now to put in 200 units of multifamily. We went to the city and we said, hey, you guys need some affordable product. This is opportunity zone. We've got this old warehouse. We'd love your help to get rid of this old warehouse in your growing area, but we're going to need 2 more floors. We're going to need some exceptions here, and we're going to give you some affordable for that. So the city's really on board with it. But Neil, what we did in that was we really took advantage of some tax plays there, because as a lot of your listeners know, opportunity zones are where you can defer taxes.
That's right.
But you do have taxes to pay in 2026. Well, Neil, we did a cost segregation on the building, and we figured out that we had $1 million of our $3 million in capital we put in the deal that was going to come back in year 1 through the cost segregation. But then the next year, in 2024, we're going to tear the building down. So we're going to have a complete loss. Mm-hmm. So by 2026, none of our investors will have any taxable event due because of the depreciation they're going to be able to take on the way that deal just rolled out. So that one's a pretty fun one. And then we're going to build 200 units of apartments. We're going to use some federal grant money on the 9% tax credits, and it'll be a great addition to the city.
Tell me how you ended up sourcing that particular deal.
I have found that while I do have, I did have for a long time my real estate license. My son is a licensed realtor as well. He's a 5th generation realtor. I've also found that it's very important to make sure that the realtors know that I pay a commission to whoever brings me the deal. Mm-hmm. Because a lot of realtors, they look at that and they go, well, you're in the real estate game. I can't bring it to you because I'm going to get aced out. So we always make sure that everybody knows, hey, we pay commissions. We're more than happy to participate. And I had a realtor call me on that. He was actually the listing agent. He called me on it and he goes, hey, I know you like opportunity zone stuff. And we were able to come up with that deal the day it hit the market, and we were able to craft an offer that made sense for everybody, because we understood what the seller wanted out of it, and we were able to get it across the finish line.
Between your first deal, it sounds like you clearly identified in a hurry that your job is to solve people's problems from a development standpoint. Yeah. Outside of that, between your first deal and your most recent deal, what are the top 2 or 3 biggest lessons you learned over the course of that, 20 some odd years?
Oh gosh, only 3, huh? The thing is, Neil, if you're solving problems, if you're solving for X, I think that's the biggest thing that people forget is there's always a new problem to solve, right? I mean, we went from, I remember when 9/11 happened, right? That was like world ending, like everything shut down and stopped. Then we had, all these other things that have happened, and we had COVID. Now we've got a recession that can't seem to produce itself, but we see things happening, right? But everybody's still buying stuff. I mean, we're still having pricing problems. But what I've realized is that if you can solve people's problems and take the time to stop asking what's in it for me and start figuring out, how do I solve that problem? How do I get you to your goal? And if I know what that is, then I can figure out how I'm going to make money and do mine on the side. I mean, that's easy. But if I can show you how to solve your problem, then I'm going to wind up with a deal. And if I can do that consistently enough, then we're going to have lots of these deals to do, and we're going to stay very busy. And the other thing is don't be greedy. Be willing to participate with others and share. Look, there's guys that are great at sourcing deals, but don't have an audience, don't have capital, don't have access to development resources. But and over the last several years, I've really concentrated on broadening my network to make sure that I know capital raisers, that I know people that can source deals. I know people that own property management companies in other states. And I've recently started spending a lot of time with an asset management company because I'm getting to the point where I'm too Our asset holdings are too big for us to self-manage on the asset side and the property management side. They need somebody in there to make sure everybody's doing what they're supposed to do.
It's a nice problem to have, but it's still a problem.
It's still a problem, right? I mean, all you ever do is create bigger ones.
Yep. No, there's no doubt about that. You mentioned that we stand here probably or within maybe a month or so of being in a technical recession, and it hasn't manifested itself. We're at the yield curve is the largest inversion since September of 81, as you and I sit here and record this. I guess right. as you look forward to down the line from Mike, I got two questions here. As an active investor, what are you doing? And what's the outlook for the balance of the year? And then from a passive investor standpoint, where do people go? What do they do? How do they place their dollars and cents in operators in this type of environment?
And I think, Neil, what I'm doing is the same thing I've always done. In 2021 and 2022, we didn't do any increased number of deals. We did the same number of deals in 20 and 21 and 22. And yet we saw other people that went for the moon, right? They were finding a deal under every rock. And what we're seeing now is that, well, maybe that wasn't quite as good a deal as you thought. Maybe it's not going to work out quite like you thought. But experience also tells you have to look at history. I love how you just said, yield curves inverted all the way back to 81, right? That means that we're paying attention to history because it's the best teacher, unless you want to take the shovel to the face yourself.
Yep.
So when you look at that and you go, hey, we're going to head into a recession. What am I going to do as an investor? I'm still underwriting to an 8 cap, right? On development stuff. I'm still looking at stuff that has to cash flow on day one. I'm still looking at, Neil, I just underwrote a deal that I think is an excellent deal that I'm telling my investors is a 15% IRR on a 5-year hold. That's 6% cash on cash day one, goes to 9% within the first 18 months. But there's all these different levers I can pull. I can do a refi if rates improve. I can get us, I believe that I will get more than 3% rent growth year over year, and I can probably get 9% year one, but I'm not underwriting that way. And if you have to pencil whip this thing to the point that it becomes this amazing thing, then you'll have investors once. But then, as a lot of people are finding out, it's the experience. It's the knocking your head on the door. It's bumping in the dark and realizing why you write to an 8 cap. Why, we saw during COVID, we saw lumber go from 400 1,000 to 1,700 1,000, down to 1,100 1,000, back to 700 1,000, and now it's back to 1,100. How is it 1,100 1,000 going into a recession?
Right.
And so what you learn is that experience helps you underwrite properly. And so I would ask you, if you're talking to your passive investors, you have to look at the experience of the actual underwriter. You have to look at the person that is doing this, and what is your cap rate compared to 6 years ago? What is your interest rate compared to 5 years ago? Because those are really more normal times that we're going to return to. This is not a new era. This is a return to normalcy as you and I know it.
Yep, I would agree with that. We've got mean reversion as it relates to going back to historical averages, and to think that, and I think homeowners got really accustomed to interest rates in the 3s and the 4s, and so there'll be a shock in that environment. But from a business perspective here, things have to pencil, and they have to be able to. I love what you said. They got to be able to cash flow from day one, and what that means, and what I hear you saying is, you're not putting together the basis of your investment relying on assumptions, relying on high single or double digit increases in rent to make the thing pencil.
Well, Neil, how many times did you see where they had gone in, a seller had gone in and said, hey, we remodeled 5 units and we were able to get $300 a unit more for those 5 units. So we've modeled out our sales price at that price. Mm-hmm. So we're taking that off the table, but you get to do the work. And then we're also taking a 4 cap on the deal or a 3.75 cap on the deal. And then we're going to go to a highest and best final round, right? By the time you got done, everybody just sat there and slit their wrists and bled out as much as they could, and the winner got the deal. But then you had all these problems that you had to then solve for to get to perfect. You had to be perfect,
correct,
to get your deal to work at all. And the reality is, as we've seen in the last 18 months, nothing has been perfect.
Right.
And nobody would have estimated that we would have gone up as fast as we have with interest rates and things like that. So you have to expect that things will not go perfect and that you will have some ups and downs, and how you're able to manage and monetize that that's really where the money's made in commercial real estate.
You make it on the buy. Yeah. And what I heard you say, you had to be perfect. Not only did you have to be perfect from an execution standpoint, your assumptions had to be perfect.
Yeah. Yeah. And your market your uncontrollable market had to perform perfectly also.
Yep, you're absolutely right. Tell me you're largely you're in multiple asset classes, and I think it's fair to say industrial is a favorite one.
Industrial's always been my personal choice. I've done a lot of multifamily because everybody loves it for whatever reason. I mean, let's just do a quick comparison. In multifamily, you have tenants that draw on the walls. They plug up your sinks and dishwashers. They have dogs that poop in your yard. They rarely have credit. They will leave you for $50. Let's see. They usually don't even have insurance on their valuables, let alone yours. Whereas if you shift over to industrial, you've got businesses that are established with people that sign personal guarantees, that have assets and tools and trucks and things like that. They put down a security deposit equal to 1 month's rent. And all of the expenses, the CAM charges, the common area maintenance charges, are all additional expenses to the tenant. So you're really something of an anomaly here, where if insurance goes up, the tenant gets to pay for that. If property taxes go up, the tenant gets to pay for that. So your NOI is your NOI, and it always is. And you're in multiple year leases that have fixed increases on the rent, so you know where you're going to go. It's not something that can radically improve in price like multifamily can, but then again, it's something that continues to appreciate at a very steady pace over time. So I guess I am a little biased.
But it seems like between those two, right, single family, or we'll call it multifamily, and industrial, they're the two ends of the extremes as it relates to the experience of commercial real estate, the underlying tenants.
Yeah, it absolutely is. And I think a lot of that comes from, the Beardy Brandon, bigger pockets side of the planet, where, everybody, I mean, look, Neil, you've been in this a long time. I have too. We never heard of house hacking when we started, right? That's a millennial phrase. I mean, we never thought to buy a fourplex and rent out the other three. But when people start out that way and they're able to make money that way, and they keep doing it that way, they go from 4 to 12 to 24, and they kind of get ingrained in the fact that multifamily is the way to go. Multifamily is an asset class for sure, and it does offer some multiplicity to it, because you have 300 tenants in one place, and it's easy to manage with on-site management. Industrial doesn't quite offer that, but then again, it doesn't really need to, because the tenants by and large manage themselves, And so when I look at those, they're very opposite ends of the spectrum, and I can see why people pick the ones they pick, or how they got involved in real estate and why they gravitate towards that. But I think the reality is, you should put on, rose-colored glasses and look only at one thing. What's your cash flow? Right? I mean, what's your ROI? What's your IRR? When it comes down to it, what is making you money, and can you afford to go all in on one class?
Yeah, can you afford to go all in on one class? It's an interesting question, because you'll see a lot of people scale up to the point where they are all in on one class. They as if there's no other class that could possibly work or operate or benefit. What percentage? I'm going to a couple of questions here, but as you look at multiple asset classes, as I do, what percentage in your mind of it is not so much the asset, the differences between multifamily or industrial? What percentage of it is the underwriting, the similarities between the asset classes. What percentage of each asset class is similar to the other? That's probably better.
I think the banking is very, very similar, right? The benefit to multifamily is you can lock in 30-year money.
Yep, right.
If you go for HUD debt, you can get 40-year money, right? That stays locked for 40 years. So coming through the last cycle that we had, I know people with really large portfolios, I'm talking $2, $3, $4 billion portfolios, they locked in a lot of 3% money, right? And they'll have that for generations, literally. The industrial side, the banking, the longest you're going to get is 10 to 15 years on the lock with a 25, maybe even a 30-year AM. But, so banking is very, very similar. Asset valuations with cap rates are similar, that everything comes down to cash flow. For whatever reason, industrial tends to trade a little bit higher than most multifamily. A multifamily, if multifamily is 5, you're going to see industrial 6.5, 7, just historically. Tenant management is totally different. With the triple net, I was in one of my buildings the other day. I hadn't been in there for couple of years, and I was the tenant had redone the flooring and painted the office, and I said, don't you have to get landlord approval to make alterations? And he says, screw that guy. All he was going to do is charge me 15% to come in and do what I could do myself anyway. And I said, you know what, you should dump that bomb and build your own building. And we just kind of chuckled, but that's the reality, right? He replaced all the flooring in his offices and repainted it, but he knew that I was going to charge for that. Whereas multifamily, a lot of people will move because they want the upgraded experiences. And so, I think that there's a lot of similarities just as far as cash flow and done properly and underwriting. It's still got to make sense. You look at an exit plan at some point. Yep. You look at, your cap rate going in, your cap rate coming out needs to be higher, those kinds of things. So there are similarities, but I think the tenant, like you said earlier, is the number one reason that industrial is, in my opinion, such an easier asset to manage than multifamily and producing a fixed return.
There's lots of investment return matrix, and people you can get excited about a whole bunch of them. You can drown in them because there's so many. What's your favorite one?
As far as, I like cash flow. It's really impossible to tell me that you have a good deal if it's not cash flowing. Yeah. Right. Because we went from, we had unicorns and sunshine and nothing but unicorns and sunshine 18 months ago. Right. You couldn't buy a bad real estate deal 18 months ago. Now you're scrambling and scrapping to find a good one, right? You're working hard to find a good one. We're going to lose 60% of our realtors again, right? They're going to non-renew on the license.
Correct.
And yet the one thing that's constant is if you had cash flow 18 months ago, you got cash flow now, and you're going to go into the future with cash flow.
You've got to start all over again from scratch. What would you do and why?
Oh man. If I knew what I knew now, I wouldn't have gone solo. I've done, I worked with my dad. I saw my dad retire with cash flow when he was 50 years old. But I did everything myself. I would tell my younger self to go get a job, work for somebody that was doing what I wanted to do so that I could see the systems and build all that out. I've had to imagine everything in my world because I never got to see that from a massive scale. Don't be in a hurry to be the lead dog. There's so much that can be learned. I've watched people that have worked on Wall Street or worked in other investment shops, family offices for 30 years and come out and just gone nuclear because of what they actually know that they got in those environments. Yeah. And so I would say, go to the school of hard knocks, learn from the people that you want to be, go to work for them, learn from them, and it will dramatically increase your trajectory and your time to the top. You'll get there at the same time. You'll just be much better positioned to do it.
A question for the passive side. So somebody's out there that, they want to participate and they look at deals every now and then. How do they look at more? How do they find more operators? And then once they do, how do they identify a good operator that they should, that they'd want to latch onto and put money into with them inside of a deal?
I think you have to take away the last 2 years. I think you have to negate the returns of the last 2 years for everybody, me included. right? I mean, we had a deal that went 102% in 20 months, right?
Wow.
I probably couldn't replicate that again in my lifetime, right? But I'll take it. I mean, a win's a win, right?
Right.
But if you look at that and you really have to, I would say as a passive investor, spend some time to understand the underwriting. If you can't understand it, it's probably not for you, right? And then the other thing is, I am absolutely shocked and surprised at how many people don't come see me. You just sent me a check for $100,000 and you don't have a half a day to fly into town, get in my car, go look at what I'm doing, see my project, shake my hand, look at my office and my operation, but you'll send me money? And I think the people that didn't do that are finding out they probably should have with some of the investors, that the sponsors that they're working with. And those are all things that we've all learned, right?
Fair to say there's a difference between those who cut their teeth putting their own money at risk, doing their own deals without other people, versus those who have only ever syndicated, only ever put deals together with largely investors' dollars at risk.
Well, exactly. And you know what? I haven't cut. These are not my teeth. They've been knocked out. These are replacement teeth, because that's what life does to you, right? But those are the lessons that I've always learned, is the ones that hurt. And I learned all those lessons in my life. I didn't start syndicating until about 4 years ago, because I was doing deals. I was doing deals with one partner, and I got to the point where I was too big for them, the single check writers. But at the end of the day, you're absolutely right. If you have not lost your own money, you have no business handling someone else's, because that needs to be even more precious dollars than your own. But you don't have the experience. I mean, look, Neil, if you remember 2008, we had half the audience was just frozen. Half the audience was sitting there looking at it going, there is a train coming. This is going to be bad. This is going to be really, really bad. And they stood there frozen because they didn't know what to do. And the other half that jumped out of the way, well, they had been through the last recession and they knew what was coming. They knew what was happening. And here we are again, 12 years later, 14 years later, again, facing a very difficult economic time. And we have those that have the experience and those that don't. And these are things that you can't learn in school. You can't get from a book. You just have to really know what you know and have to really have gone through the issue.
You've got to have the intestinal fortitude to be able to get through it. We're
the scars.
And the scars. Yeah. Tell me, speaking of that, TREP indicates that 46% of all commercial mortgages will come fully due and fully payable between now, 2023, and the end of 2027. As an active operator, how do you position yourself to strike?
This is where everybody that was not running off the cliff like lemmings trying to get in and be one of 15 best and final has kept that thing called dry powder around. Mm-hmm. And this is the thing. Look, we're going to see leverage continue to compress as interest rates increase, which means that, you borrowed $10 million on a deal that didn't even have a DSCR comparison 2 years ago. Your money's going to come due in another 3 years. And it doesn't matter that you've had good, solid 3 and 4% rent growth for the last 3 years. You're not going to be far enough ahead to take up the slack between 3% and 7% interest rates and what you paid. So you're going to either have a capital call or an event where you're going to have to sell, but you're not going to sell for what you have into it because it hasn't appreciated enough to offset the change in the debt price. And when that happens, the people that are there that go, I can be your problem solver and get you most of your money back, are really where you're going to see them make money. And as you'll find, more businesses are started in recessions than any other time in history, and more money is made in recessions than any time in history. And so I think I think anybody that says that they didn't make money the last 3 years, I would definitely stay away from them. But I would look at the people that are going in with their napkins tied around their neck, their fork and their knife into the next 3 years, as those people are going to make fortunes.
Generational wealth is built during recessionary times. Yeah. Shannon, this has been a terrific conversation. You're a wonderful and experienced operator and very articulate. And I think you've got a really sound vision and forecast for where things are headed and how you can strike. For people, they want to find you, they want to follow you, they want to connect with you. What should they do? Where should they go?
It's really easy. Go to shannonrobnett.com. If I can't remember that, it's time to go home. But shannonrobnett.com, you can get all of our information there. There's a link to my calendar. I'd love to have you click in, book a call, chat with you, talk investment strategies, tell war stories, whatever you want.
That sounds great. We'll make sure we get the link placed below in the show notes for everybody to connect with Shannon there. Shannon, I really appreciate your time. Thanks so much for being on the show.
Neil, always a pleasure, my friend.
You bet. I'll see you guys soon. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.